the interpretation of deltas and how you can actually make an idea behind it. And it's always wise to remind yourself about who does what at certain times, because the big question is, well it seems that everything we see on the hero seems to be back to front. The sell pressure always seems to be bringing buying, and the buying always seems to be bringing selling. I don't quite understand why that's the case when all the advertising material that goes with the hero indicator seems to be saying selling goes with selling and buying goes with buying. It doesn't seem to be the case when you start watching it in real time, of course. So there's obviously got to be a lot more to understanding gammas and deltas than that. And some of the answers can be found in something as simple as your PC, puts calls. Talked about it yesterday. And it's something that you should be paying attention to, guys, because this is also something that some people say, but I don't get it, that big surge in the puts calls. Why do we see the price buying when we see that? It should be very obvious for anybody that's traded options before, or anybody that's been a professional in the markets who knows about options, or any of you guys that know about options. It should be obvious why you get these types of pops, why you get these types of holds, which happened a few days ago, of course, at the bottom edge. And it all lingers around this idea of expensive stuff. So, for example, if I own a put option here, and it's at a top edge, and I own some put options in here just because I've been buying some hedging, because I'm maybe a little bit bearish the market, right? And the prices have been doing okay. We've managed to see the price rallying up, and we've managed to see the price rallying up again, and we've bought some cheap puts. Why are they cheap? Volatility is really, really cheap, right? So we're buying some cheap puts. So we use those areas to maybe buy some cheap puts as a hedge, because we've got other things that we think are a little bit more bearish. For example, a defensive rotation by the big boys, the big funds. So we buy some cheap puts in the market. We hedge our downside portfolio. Now, obviously, what makes up the price of that put option? Well, one of the big things that make up the price of that put option is volatility, right? It's one of the big contributors to put option pricing. Does everybody understand that? Yes? Volatility. So when it's at the top edge, volatility is cheap. So my put option is cheap. So what happens when we get a massive spike in puts? What do you think usually happens to the VIX when you get a massive spike in puts? What normally happens when you get a massive spike in puts? What do you think should happen? You expect a big spike in volatility, right? So what happens? Only one person knew the answer to that question. Okay. So if I'm watching the puts calls, and the puts calls are maybe doing this, and then all of a sudden we start seeing this move here. We start seeing this move here, and the price actually starts getting hit because of the internals and all sorts. And we see this really, really big spike in the PCs. That big spike is going to bring a huge spike in volatility. I am going to be, even if the market hasn't dropped that far, I'm going to be making a fortune on those puts because of the spike in vols. So because of that big spike in vols, what do? Well, I know that that volatility is a very, very, it's a passing phase, isn't it? Transitory, to use a Federal Reserve comment. We don't see high volatility for very long most of the time, because once it's in, it's in. It doesn't go anymore. So when I get a massive spike in the puts calls, I'm gonna buy out all of my put options at that stage, right? So I'm going to be a buyer of my put options here. Well, if I buy put options, if I buy my put options back, if I buy my put options, I'm now talking about a dealer. If I close my put options, I'm long puts. So if the dealer takes the other side of that trade? Who's buying this price in the stocks? Well, what am I going to do as a big fund manager? And I've managed to buy puts up here. What am I going to do as a big fund manager? If I've managed to buy puts through this top edge because of the weakness in the rotations, I can now go into the market and buy cheap stocks. But who else buys cheap stocks? Outright commercial buyers, perhaps, because it's cheap. Who else? The dealers. Why would the dealers buy cheap stocks? Exactly. Exactly. If I close out my put options, what was the dealer's position when I bought the put option? Short gamma, right? Short gamma. The dealers were buying into this storyline by selling stock. Short gamma. So the dealers were short gamma. So they sold stock during that period. So when we get that big spike, I start buying stock, but I close out my put options. If I buy stock and close out my put options at the same time, the dealer buys back their short hedge. So the dealer comes in and starts buying as well. And what normally happens in that type of environment is we normally get a very, very fast money buy response because there's no sellers anywhere to be seen. No sellers anywhere to be seen at that stage in the book. So that should start to make a lot of sense, shouldn't it? That should start to make a lot of sense when you get a big spike higher high, and then you see the big volume surging into the markets. So if I said to you, where would the buy trade be on this chart? Where would the buy trade be on this chart? You can have a look at it and you can start trying to tie in those simple pieces of information, can't you? You can start trying to tie in the simple pieces of information. Spot me a buy trade on this chart, guys. Spot me 2 buy trades in this chart. Well, we can see that there was a higher high here. Yes? So everybody that owns a put option are probably going to be exiting their puts at that stage. And we can see obviously at the open here, there's a huge surge here. Does everybody get that? Does everybody understand that? So there's 2 places that we should look for big stock volumes. Here, which is at the close, and here, which is at the open. So there's 2 places where we can look for huge stock volumes. This day here, which was the close, right there, and this day here, which was at the open, right there. So the 2 biggest times for volumes are the 2 biggest times for these big commercial trades, correct? Absolutely. So when we think about those, we can start to recognize the 2, why people use the opens and the closes to do some of this massive business. So when I look at the S&P, were these 2 good opportunities to buy into? I don't know. Let's check it out. Were these 2 good places to buy into it? Well, absolutely. So when you bought into that one there was no risk to this retest, by the way. So there was no risk to this retest. So you know that that's going to probably be a buy in the overnight session because you know it's going to open bid. So you're just buying this whole phase, aren't you? You're not going to be concerned about that one. You're just going to buy that cheaper, 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 cheaper right in the overnight session. This one just automatically gone buy side bounce off of that price. Boom. And you see what happens when the American session then opens? Because remember, this buy trade here was at a close. So because this buy trade's at the close, that trade hasn't yet been traded by the US markets. So when the US markets come to desk, you can see it explodes north out of that area. Not just an explosion, a nuclear explosion. This one was at the open, so you can see that that's automatic that it goes straight north because of the size of that volatility spike, which is going to be unwound into long equity positions. So the bigger they spike, the bigger the volatility, the bigger the profit for the put option buyers. And it usually takes place when equities have already sold massively. So we're getting two massive improvements, aren't we? All the put option buyers, every single put option buyer that came in this top edge here, look at the amount of profits those have got in terms of this, just the pure intrinsic value of the option. So if you've got massive profits on intrinsic value and then you get an extra Brucey bonus of a surge in volatility to make your option even more expensive, you're going to absolutely destroy that on an exit, aren't you? And obviously the same was true of this one. I mean, this was not just any sell-off. This was a huge sell-off from these high prices. All the intrinsic value you've got on all your options. The 42s, the 42 evens, the 41s, the 41.5s, the 41s, the 40/50s even, which became in the money. The profit that they're making because of the big sell-off and the huge volatility means that there is absolutely no question what I'm going to do as a trader. I'm going to cash in my puts and I'm going to buy wads of cheap stock because of that money that I'm making because of the volatility and the intrinsic value that's built into that option. Does that make sense, guys? I mean, I've tried a few times to explain this. And, you know, with the questions that I sometimes get in Smart Alpha or in the class, I sometimes struggle to see whether anybody is actually understanding it. But I think, obviously, this is understandable, yes or no? I mean, I don't know. What do you think, Mike? Does that make sense to everybody? So this is why we look at the, this is why we always look for those big spikes in the puts calls. Big spikes in the puts calls usually come with big spikes in the volatilities. Usually, not always. But when you look at the puts calls and you look at volatilities, they nearly always do tie up, but not always. As I said, there are occasions when they don't tie up, simply because the hedging is a big spike in the puts can be a big hedge. That could reduce volatilities because everybody's hedged. So we want to try and just make sure we understand that, especially when we make a new big scalp high or a big drop lower. Right, we've just touched that 27 now, guys. On the S&P, we've hit the gamma 0 point. You see, that's exactly where we're looking to go, guys, right there. Well, Daniel, absolutely right. A high volatility put option is absolutely sellable because the business plan for the big funds is what? What's the business plan for the big funds? To own stocks. So they can use that high volatility to buy more stocks at cheaper prices. Their cash holding they can then use to buy cheap stocks, plus the profit they're making from the high volatility on their put options. They can use that to buy more stocks, and more stocks means more dividends. More dividends equals a better performance of their overall fund. They're averaging down without having risk because they're obviously in the put option in the first place. So when they're buying stocks, they're buying it with the profits they're making out of those puts.